Welcome to the Deep Dive. Today we're jumping into the world of U.S. public company reporting.
That's right. We're going to try and demystify some of those key forms you hear about, the 10K, 10Q, 8K.
And also tackle a really crucial metric, earnings per share or EPS.
Exactly. The goal here isn't to drown you in jargon, but, pull out the core stuff.
Right. What do you really need to know to understand how a company's doing based on these filings?
We want to show why this reporting, and EPS specifically, really matters for gauging performance.
Okay, let's dive in. SEC reporting requirements.
Yeah.
The Securities and Exchange Commission, the SEC, they set the rules.
And companies file everything electronically through the system called EDGAR.
Which is great because it means it's all publicly available. Anyone can access it.
Yeah, it creates a standardized playing field, sort of, a consistent way for companies to talk to the market.
So first up, the big one, the 10K, the annual report.
That's the comprehensive one. It covers the business, the risks they see, financials, operating results, basically the whole picture for the past year.
And management's view on it all.
Definitely. And, there are different deadlines. Large companies, the big players, they have 60 days after their fiscal year ends.
Faster turnaround needed there.
Makes sense. Smaller companies get a bit longer, 90 days. It depends on their market cap, mainly.
Inside the 10K, what are the must-read sections?
Well, Item 7, the MD&A management's discussion and analysis, is key.
Right, that's where they explain the numbers, the trends, what keeps them up at night, maybe?
Sort of, yeah. Risks, uncertainties, any big changes. Then Item 7A looks at market risk, things like interest rates, foreign currency swings.
How exposed are they?
Exactly, and how they manage it. And then, of course, Item 8, the actual financial statements.
Audited ones, balance sheets, income statements, the works. Plus the auditor's report saying they've checked it.
And CEO, CFO certifications, which became a bigger deal some years back.
Okay, so that's the annual deep dive.
Yeah.
But things change faster than that.
They certainly do. Which brings us to the 10Q, the quarterly report.
Covering the first 3 quarters of the year.
Yeah. It's an update. Financials in there are usually unaudited, often condensed.
So, quicker, less detail, but more frequent. Deadlines are tighter too, right? 40 or 45 days.
Correct. Again, faster for the bigger companies. The MD&A here focuses on material changes since the last 10K.
Makes sense. Comparing this quarter to last year, that kind of thing.
Year-to-date, quarter-over-quarter comparisons, yeah. And any significant market risk updates.
But what if something really big happens between these quarterly filings, like a sudden major event?
That's the Form 8K, the current report.
For unscheduled material events.
Exactly. Think things like bankruptcy, a major acquisition or sale, changes in auditors, new directors or officers, stuff investors need to know now.
Then the deadline is tight.
Generally within 4 business days of the event happening, so it's pretty rapid information.
Okay, that covers the main forms, 10K, 10Q, 8K. Let's switch gears a bit to earnings per share. EPS, you see it everywhere.
You do. Public companies, or those about to go public, have to show it on their income statement. It basically boils profit down to a per-share level.
Simple concept, but I gather the calculation can get tricky.
It can depend on the company's capital structure. Is it simple or complex?
Meaning?
A simple structure just means they only have common stock outstanding, easy. They just report basic EPS.
Okay, and complex.
That's when they have other securities that could become common stock. Things like convertible bonds, stock options, warrants.
So things that could potentially increase the number of shares later on.
Precisely. And for those companies, they have to report both basic EPS and diluted EPS.
Let's start with the simple one. Basic EPS. How's that worked out?
The formula is income available to common shareholders divided by the weighted average number of common shares outstanding.
Income available to common. So net income minus any dividends paid to preferred stockholders.
Exactly. You subtract preferred dividends because that profit isn't available for the common shareholders. And you use the weighted average of shares because the number might change during the period. Maybe they issued more shares or bought some back.
Right. Time weighted. Makes sense.
And things like stock splits or stock dividends are treated as if they happened right at the beginning.
Okay. That's basic. Now, diluted EPS for the complex structures. What's the idea there?
Diluted EPS tries to show the potential impact, the dilution, if all those convertible securities were actually converted into common stock. It's a sort of worst-case scenario for EPS.
How does that work for, say, stock options?
For options and warrants, we use the treasury stock method. It assumes the options are exercised, the company gets cash, and then uses that cash to buy back its own shares in the market.
Okay.
If the average market price is higher than the exercise price of the options, the company can't buy back all the shares issued. So there's a net increase in shares outstanding.
which lowers EPS, makes it
Okay.
diluted.
Correct. If the market price is below the exercise price, exercising wouldn't make sense. And the options are ignored for diluted EPS. They're anti-dilutive.
Got it. What about convertible bonds or convertible preferred stock?
We use the if converted method. Assume they converted right at the start of the period.
So for convertible bonds,
You add the shares they'd convert to the denominator. And importantly, you add back the bond interest expense, net of tax, to the numerator. Because if they converted, the company wouldn't have paid that interest.
adjusting both top and bottom.
Yes. But again, only if doing so reduces EPS. If adding back the interest and shares actually increases EPS, it's anti-dilutive, and you ignore the conversion for the calculation.
And convertible preferred stock, similar idea.
Similar, but simpler. You just add the conversion shares to the denominator. You don't adjust the numerator because preferred dividends were already subtracted to get income available to common. Same anti-dilution rule applies.
There are rules for other things too, like shares that might be issued based on future earnings.
Yes, contingent shares. They get included in diluted EPS if the conditions seem likely to be met based on the current situation, assuming they're dilutive.
So quite a bit goes into that diluted EPS number.
Definitely. It gives a more cautious view of earnings power when these potentially dilutive securities exist.
And what disclosures go alongside these EPS numbers?
Well, first, you can't report cash flow per share. That's a no-no. But you need to show a reconciliation how you got from the basic EPS numerator and denominator to the diluted ones.
Show your work, basically.
Pretty much. You also have to disclose the impact of preferred dividends and list any securities that could have been dilutive but weren't included because they were anti-dilutive in that specific period.
And any big share changes that happened right after the period ended.
Right. Subsequent events that could materially affect shares outstanding.
Okay, so wrapping this up, understanding these filings, the 10K, 10Q, 8K gives you this flow of crucial info.
It's the company's official story, regulated and accessible.
And EPS, especially comparing basic and diluted, helps translate that company-level profit into a per-share figure investors can use.
It's a key metric, though. Like any metric, it needs context. Understanding how it's calculated, especially diluted EPS, is vital.
So a final thought for you listening. When you see these reports and the EPS figures, how does knowing about the potential dilution and the management commentary in the MD&A change how you might assess a company's future prospects compared to just looking at the headline numbers?
Something to ponder. Thanks for joining us on the deep dive.